Westpac sold its entire stake in Zip after they announced that they are going to provide default banking services for Afterpay. Talk about jumping ship to ensure its own survival in the millennial market. While all of that is happening, Zip is moving pieces on the chessboard, partnering with Visa, Google, and Apple to enable a tap and go feature for Zip customers. We also got to talk about PayPal officially accepting cryptocurrency as a form of payment and Tesla's Q3 earnings result. I'll leave timestamps in the description box below, so feel free to jump to a section whichever that interests you the most. As usual, this video is not financial advice, but if you do learn something new, consider gently smashing that like button right there and let me know in the comment section below in terms of what you think about PayPal officially accepting a selected few cryptocurrency as a form of payment. So without further ado, let's go! For transparency's sake, I don't have individual positions in Westpac, Zip, or Afterpay, so I'm not invested. First things first, Westpac announced that they are selling their entire stake in Zip a day after they announced that they will be providing default banking services for Afterpay. I'm going to comment on that in just a second. Now, the deal between Westpac and Afterpay enables Afterpay to offer savings accounts to their customers. In my opinion, this is a key milestone for Afterpay's personal finance ecosystem. Once you can monitor the non-discretionary spending part of your customers, you have a very holistic view to leverage for future product development. I mean, think about it. Your bills, how and when you spend your money to buy groceries, when do you receive your paycheck? Do you really think Afterpay will let those data insights go to waste? No. Now, once Afterpay have tackled the savings and spending part of your financial well-being, how long do you think before they'll get into the investing part? I'm not saying they will, I'm just saying that by offering savings accounts, they now have a lot of different opportunity to expand into. And for Westpac, this in my opinion is a desperate move to rekindle their relationship with younger Australians. On that note, let's go back to Westpac selling its entire stake in Zip. Now, it's worthwhile mentioning that Westpac bought their shares in Zip in 2017 for $48.9 million. And they are planning to sell their entire stake for $367 million. This is a 650% return over a 3-year period, and if you were to put the same amount into Westpac stock, you would have lost money. So it seems like I'm taking a jab at Westpac. Well, that's because I am. As an investor in Zip in 2017, they could have taken action and incorporated them more deeply into their Westpac offerings. But guess what? Not only were they slow in incorporating Zip, they even explored a competing product called Smart Plan in 2017. Exactly same concept, interest-free and installment options. I won't go into the details, but if you're curious, read Westpac's 2017 press release when they first invested in Zip, and let me know in the comment section below how many of those things actually came into fruition. To be fair, maybe this is just how Westpac stays relevant. Now, because approximately 55 million shares will have new owners and Westpac is selling that stake, a lot of investors who haven't done their research will panic. Because of that, I think the share price will fluctuate a lot, like my hands shaking right after a really strong pre-workout shake. It's not all bad. Before the drama of Westpac selling its entire stake broke out, Zip partnered with Visa, Google, and Apple to offer a tap and zip feature. This is a great move to work around the limited amount of stores who accept buy now pay later and the current Zip experience of scanning barcodes. Not only that, by partnering with a global payments company, this gives Zip a new channel to be part of millions of transactions in Australia. And if it does work out for both companies, then I really think they'll explore the option of scaling this solution across the world to other countries where Zip also have a presence. Of course, there are some potential downsides to this as well. With MasterCard and Visa, the interchange fee is approximately 0.43% here in Australia. And Zip's margins on their core product is estimated to be 2 to 3%. So going down this path might mean that Zip can process more transactions but at a lower margin for their core product. Lower margin is one thing, but Zip also have to deal with the conundrum that merchants might not want to sign up with Zip because of the tap and zip feature. Why sign up and pay extra fees when customers can just tap and zip? right now, this is not exactly a problem because Zip is actively helping their merchants access more customers. Okay, so Afterpay can offer savings accounts, Westpac have Jumpshipped, and Zip have now enabled tap and zip feature. But I think Zip has a secret weapon under its sleeve, but I don't understand what they're doing with it. And that secret weapon is Pocketbook. This is Zip's personal finance app that has more than 800,000 users, while Afterpay have to sell their customers a bank account just to see what else they're spending their money on. Pocketbook can see all of the transactions in multiple bank accounts if the user have connected multiple bank accounts. That kind of information is something neobanks and fintechs can only dream about. In Zip's 2020 annual report, they have documented that Pocketbook have tracked over 1.6 billion transactions, totaling $360 billion worth of spend. There are so many things you can do with those kind of data points. For example, if you see a group of users that are paying a certain amount in car insurance every single year, but given their age and their petrol costs, which indicates how often they drive after adjusting for oil prices, could you not make an observation that they might be paying too much and potentially recommend a product that could save them more money in the future? Yes, I understand there is the behavioral side of insurance as well. Maybe the driver is a maniac. Look, I'm sure that Zip have done their due diligence in exploring different monetization opportunities with Pocketbook, but I'm just curious and I want to see them to do more with such a great platform they have. Next, let's talk about PayPal accepting cryptocurrency. No, they're not releasing their own digital currency, or maybe not yet, but they are enabling PayPal users to buy, hold, and sell a selected few cryptocurrency within the PayPal digital wallet. The cryptocurrencies they accept right now are Bitcoin, Ethereum, Bitcoin Cash, and Litecoin. What we know so far is that the service is incredibly contained in the PayPal environment. You won't be able to deposit your cryptocurrency into the wallet and you can't withdraw it or transfer it. Once you buy the coins, it'll stay in your wallet until you sell it. And there is a purchase limit of $10,000 per week or $50,000 per year. One of the main reasons why this is such a big deal is that PayPal is not a small fish in the ocean. Globally, PayPal have more than 300 million users and approximately 40 million users in Venmo. They are certainly not the first to embrace this movement. Square's Cash App, Robinhood, and Revolut have all enabled services that allow their users to buy, sell, and hold a selected few cryptocurrencies. But for a behemoth like PayPal to finally take notice of cryptocurrencies, it certainly validates that there is an opportunity there that even PayPal cannot ignore. On the point of a greater opportunity within crypto, I dedicate 1 to 2% of my portfolio towards Bitcoins. It's important for you to know that I'm not trying to convince you of anything. This is just my opinion and this is my logic on why I dedicated 1 to 2% of my portfolio towards Bitcoins. As a small retail investor, my objective is just to allocate my hard-earned cash in places where it'll grow my net worth. Now, there are multiple asset classes you can choose from. You can go with real estate, bonds, stocks, or straight cash. You already know that I am heavily invested in stocks and I'm not very interested in bonds right now just because of low interest rates. And real estate is just very expensive and it's something that I'll be considering sometime in the future. So if I want exposure outside of stocks, I'm left with gold and Bitcoin. Gold is often treated as a safe haven asset, and in the case that our world goes to crap, at least I have some gold bars that I could potentially trade you for some goods and services. It stores value really well, which means that even if our government prints money like no tomorrow, the amount of goods and services that we can buy with gold is not going to decline. With gold supply, it's incredibly difficult to pinpoint how much of gold there is on Earth. You can estimate, but the problem with estimation is that Uncle Quan could strike a gold mine somewhere in the world and not choose to tell anyone. And even if I do choose to tell someone, maybe it'll take days or even weeks before the actual supply gets updated, which then will ultimately impact gold prices. With Bitcoin, there are 21 million Bitcoins. That's it. On top of that, the utility of a gold bar, if our world goes to crap, is really clunky. If I want to buy something from you using my gold bar, how do I get change? At that point, I'm not exactly wealthy to say keep the change, because I want my change. Bitcoin, on the other hand, doesn't have this divisibility problem. It's divisible up to 8 decimal places, so I'm definitely going to get my change. Lastly, it's really, really hard to fake a Bitcoin transaction. All transactions will need to be confirmed on the Bitcoin network to verify that money is indeed yours and are going to the right places. And the bigger the transaction, the more number of confirmation it requires for that transaction to be approved. Oh, but fake gold bars are an ongoing problem. Over the last 3 years, fake gold bars worth more than $50 million are found inside the vault of JP Morgan. Look, I'm not trying to convince anyone of Bitcoins. As a matter of fact, I still have a lot of studying to do. But the truth is, the practicality and the utility of Bitcoin, in my opinion, are more superior to gold. This is especially true for developing countries where they have to exchange multiple currencies just to get to US dollars, just so that they can buy something. Now, before I do a portfolio update, if you want access to my video scripts, my research, and also be part of my fortnightly Q&A, not to mention some additional content pieces, consider supporting this channel via Patreon. Now, I'll leave a link in the description box below for anyone who's interested, but nevertheless, it already means the world that you're watching this video. So thank you very much, and let's jump into a portfolio update. With my CMC market portfolio side of things, it's currently worth $63,300. And over the week, I have dollar average another $2,500 into VTS. The reason why over the last couple episodes I hesitated to put that money towards VTS is that that money is originally planned for Talga, not VTS. But the day I wanted to put the money towards Talga, the price went through the roof, which, don't get me wrong, I'm really happy the fact that Talga have finally reached the dollar mark, but I was looking to build on my position there. And since I'm waiting for my next opportunity to enter, I don't really like the idea of having just cash laying around not doing anything. So I just decided to dollar average our money into VTS and then wait for my next opportunity to build on my Talga position. With another $2,500 added towards the growth side of my portfolio, I'm getting very close towards my 40% target. So I still have a little bit more to invest towards the growth side before I get to 40%, but I am very happy in terms of my own progress at the moment. I don't include my Bitcoin position in my thumbnails, and I don't have a good reason for not doing so. I've only ever included my stock portfolio, and that's essentially it. So I don't plan to change that. With my stake portfolio, it's currently worth $16,192 plus 400, so approximately 16,592, which is approximately 22,000 Australian dollars. And with this portfolio, I am working towards consolidating Johnson & Johnson and PepsiCo towards Microsoft and Disney. Now, I will talk a little bit more about it as I finish consolidating, but the main reason for doing so is, again, like I mentioned in my previous episodes, I want to make sure that I have smaller amount of positions so that I can have better coverage on that. Over the week, I have also added ARKW into my portfolio since I'm really interested in Opendoor, Mercado Libre, which is the Amazon of Latin America, Tencent, and a few of the other companies, but I'm not ready to have dedicated positions. So with the spare change that I have in stake that's not really doing anything, I decided to just treat ARKW more like a high interest savings account and just invest that money towards ARKW. And yes, I have added more to my Tesla position because of the Q3 earnings call and the recall of 30,000 vehicles as well. Now, when it comes to Tesla's Q3 earnings result, there are a lot of videos out there who have covered it very extensively. So I'm just going to cover a few things that have stood out to me. Now, the first thing that stood out to me is that their automotive gross margin is 27%. That's massive. And if we add some of their other product lines together, their GAAP gross margin is about 23.5. Just to give you some perspective in terms of how big that gross margin is, if we just look at the overall gross margin for Tesla, which is about 23.5%, which includes automotive and some of the other product lines, they are miles ahead compared to General Motors, Toyota, and Ford. With the solar and storage side of their business, they have improved the deployment by a substantial amount on a quarterly basis as well as a yearly basis. Now, this is important because they have said in the quarterly report that they expect and believe that the energy business will ultimately be as large as our vehicle business. Now, for me personally, I don't think Tesla has a demand problem. I just wonder whether the suppliers of battery materials or materials in general can actually keep up with the demand that Tesla have. One more thing, the markets reacted pretty negatively towards Tesla recalling 30,000 cars that's made in the US and import it into China. Now, the Chinese authorities are saying that there are suspension problems to these cars and the investigation is still going. So I'll wait until the investigation is complete before I make any commentary. But I do want to remind you that recalling happens, and I don't think this is a fatal mistake on Tesla's end, obviously. So as the market reacted pretty negatively towards the Tesla recalls, I just added to my position. If Tesla can solve autonomous driving battery challenges, I really don't think suspension will be a problem that they can't solve. As usual, Dropbox and GoPro are not part of my portfolio. They are free stocks that's given to me if you do try Stake for yourself. Now, I'm not sponsored by Stake. I just use Stake because it's a lot easier and affordable to invest in US stocks via Stake than some of the other platforms. And on that note, if you wouldn't mind a GoPro, Dropbox, or Nike when you try Stake for yourself, I'll leave a link in the description box below. Thank you for watching this video all the way to the end. It means a lot to me, and if you have learned something new, consider gently smashing that like button right there, subscribe to my channel and click onto the bell so that when I release future videos, you'll be the first one to know. If you're looking for another video to watch, I have left something on the screen for you that I think you'll really enjoy. So consider watching that as your next video. Until next time, my name is David. Auto will always do the honors, and see you very, very soon.